Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's March 11th, and yesterday the market actually turned around, didn't close quite positive, but it didn't. It erased about 300 points on the Dow of negative price action and closed down only about 100 points down, which isn't all that bad. The fact that volatility is still in play is telling us that the market is not going into a recession, that the market is simply going through a correction. Typically, when you have recessions, you have lower volatility. You have less interest in the market. You have a lot less interest in the volatility. Right now, you have a lot of back and forth, which is telling us that participants are very anxious about what's going on in the market, which is a sign that the market is in play. So the Dow is up 400 points before the opening. We're going to be opening up in about an hour and 44 minutes or so, give or take. Yesterday, we had a major CPI report. It just verified the fact that inflationary pressure is almost at 8%, which is, crazy. Look at this, 7.9%. And if you take away food and energy, you still get 0.5%. So you could see where most of the inflation is. Or ex-food and energy, year to year, at 6.4%. So again, there's a lot of inflationary pressure right now, and that is a major factor roiling this market. Now, let's talk about global economy, and then we'll get into the nitty-gritty, shall we? So shares were mixed Friday overnight in the European markets and in Asian markets as uncertainty over the war in Ukraine and persistently high inflation hung over world markets. That's the biggest factor right now, mostly the war. The inflationary pressure is just a cherry on top. Oil prices advanced on Friday as Russian forces broadened their offense in Ukraine, attacking two major cities to the west and an industrial center in the east of the country. A plan to revoke Russia's most favored national trait status over the invasion of Ukraine added to unease over the economic repercussions between the nations. So I just want to kind of go through this with you and touch on the important parts. Oil prices went to 107 per barrel, kind of high. We were closer to a 120 a barrel, and both it and U.S. benchmark crudes are up over 40%, 40% for 2022. And folks, we're only in the beginning of March. We're not even halfway through March yet. Yeah, that's right. Though they remain below their peak levels hit this week, 130. And we have analysts who believe they may hit 150 if this drama continues, lack of a better term. Investors already were on edge because high inflation pushing central banks to raise interest rates for the first time since the pandemic began and halt programs launched to support the global economy. Now, my opinion, and maybe I'm one of the few left, I believe if this war continues, the Fed is going to do a big fat zero. They're not going to do anything. Why? Because it's very uncommon to stress the economy even further during a war. It's just a real simple common sense kind of thing. A report showed Thursday, this is what I was talking about right here on the CPI. A report showed Thursday that consumer prices leaped 7.9% in February from a year ago. You're paying 8% more right now, folks, for just about everything. Sharpest spike since 1982, and anyone buying gas at the gas station feels what I'm talking about in their pocketbook. The Federal Reserve is expecting to raise its key short rate by 1/4 of a percentage point next week. That's not a lot, and it is mostly priced into the market, but I wouldn't hold my breath. I really wouldn't hold my breath. I would be kind of surprised, or maybe they'll do it just because they feel like they have a pressure to, but I don't see this continuing. I don't see what Goldman and Merrill or Morgan are predicting 11 or 12 rate hikes this year. It's just nonsense. The first hike since 2018. So don't hold your breath, okay? Higher rates slow the economy, and the Fed is trying to raise them through to tamp down inflation, but not so much that to cause a recession. Folks, in the Fed, if you're listening to this, you may be about a year and a half too late, but what do I know? If you look at the Treasury bond, it is actually pricing in a rate hike, even though the market has been going down the last several days. If you look at this price action, it's mostly bearish right here. It's mostly bearish. That means interest rates going higher. So I believe the market is pricing in a rate hike already, a good, healthy rate hike. Matter of fact, look how much the bond has declined. It went from 155 to 135. That's a loss of 20 points. That's a loss of about 12% of its value since December. So I believe the bond market, especially the long bond, has definitely begun pricing in a 0.25% rate hike. I think that's laughable at this point right now. Volatility levels began going down yesterday, and I expect them going down today because, as I showed you, the Dow's down close to 400 points and the Nasdaq's up 230 points, and it was up about 1,000 points the day before yesterday. So I am expecting volatility to continue going down. We have a put in the volatility option, and if the volatility continues moving lower, we'll probably take profit on it today at the end of the day, maybe Monday. We'll see. Put to call ratio is still oversold. Put to call ratio is overbought, but it's insinuating or inferring for us that the market is oversold. So I wasn't actually wrong. I was actually right, but I have to preface what I said with the fact that we are in overbought territory on the put to call ratio near the 1 level. This is a threshold, the red line. Anything above here is grossly overbought, which means the market is oversold. This is an inverse indicator. This is telling us when the ratio of put buying gets too high in comparison to call buying, the market flips on its head. So the bottom line here is we're still elevated. And as long as we stay elevated, that means the market is very, very scared. And as long as it stays scared, there's a higher chance it'll go higher instead of lower, because this put to call ratio is based on panic and fear and sentiment. And when there's too many put buyers, the market turns. So I believe that the market has more upside to go. Interestingly enough, as I say that, I want to show you something. This is a 5-day chart of performance. And look at consumer discretionary. Now, maybe this is wishful thinking on my part, but consumer discretionary was like, oh, let me go back here. Let me go back a month. Yeah, consumer discretionary was right here. Let me show you this. 5 days ago, consumer discretionary was here. But wait, look at where consumer discretionary was yesterday. Now, if consumer discretionary can keep making a comeback, that would be very, 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 very bullish for the stock market. Now, let's look at the chart real quick. Now, again, maybe I'm being a little too bullish, but if this can sustain itself, and if this can break above and take this level out, the 179 level out, the next point of resistance is 190. And if we can break that, we're going to make new highs. So it is very, very important to continue seeing what's going on in the market, because if we get a rally and if we can go above to this level right here, to the 179, we will be in a much better shape than we are right here. And it would confirm that this would be a double bottom and the market would have some sentiment to at least move if we can get above 180. But you got to pay attention on the consumer discretionary level right now, because as I showed you, where was I? As I showed you a minute ago, when we looked at the various sectors, it looks like consumer discretionary. And again, don't take my word for it. Listen, look at this. Consumer discretionary a month ago. 5 days ago, consumer discretionary up here. It was down here. Now it's up here. And yesterday, this is yesterday since we haven't traded yet today, obviously. It's all the way up here. That's very, very positive sign. If we can get communication services and information technology to follow through, that would be good. But the fact that consumer discretionary is moving higher is it's the most bullish sign for a bullish economy, because what started this sell-off? The consumer discretionary and tech. And when I say tech, consumer discretionary and tech are, they're Amazon, Apple, Microsoft. Is it tech or is it consumer discretionary, right? The further we get technologically advanced, the more they're together. Now, chips is a whole different world, but again, let's just take it for what it is. And the fact that consumer discretionary has been moving higher. Very, 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 very positive sign. The fact that volatility has been going lower, very positive sign. The fact that put to call ratio is still elevated to a great degree is a very, very bullish sign. Now let's look at some indices aside from the discretionary sector. If we look at the Dow, let's just take a look at some levels for you. It closed down about 100 yesterday. It's already up here. It would be great if it can continue moving higher as opposed to filling this gap. We'll have to see. It may fill this gap and go higher. But the key level right now on the Dow that we want to supersede is the 343 level, 343 or 34,300 level. On the SPY, that level right now is right around the 441, 441.50 level. If we can break the 441.50 level, we would be in good shape. Now, this week was not a great trading week because the market was just like this. I mean, it was just like this. But with that said, we closed out a nice juicy on Friday of last week, exactly a week from today, a week back. We closed out a nice juicy 20% call profit on CNC. We were in this trade for 15 days. We got in on the 4th, which was, let's see here, right here. Got in right, let's see here. Where did we get in here? Oh, sorry, that's when we got out. 217. Let me go to 217. Got in right here. Rode the sucker down a little bit, and then got out right here. So we were in it for about 15 days, took a nice 20%, better than 6% on the average on the S&P for a year. And again, I like this stock. I think it's going to continue moving higher, but it first has to break above the 86 level. Now, folks, before I let you go, there's a right way and a wrong way to trade volatility, all right? And by the way, if we can break these levels, next week I'm looking for a major rally. But the secret to finding winning trades right now is in what I call super stocks. Our biggest winners were found by cutting out all the dead weight. Yes, the dead weight from the market, focusing us to only focus on strongest stocks. So today, I'm going live at 1 p.m. Eastern Time to go over my super stocks algorithmic trading strategy. Folks, this is all meat and potatoes. There's no fluff here. I'm not going to be talking about beautiful houses and fancy Ferraris. This is all meat and potatoes trading. I'm going to take an S&P strategy that generated 600% buy and hold for the S&P over God knows how many years cumulatively, and I'm going to show you how we could take it from 600% to 6,000% with making 4 changes. So the same asset, 4 changes from 600% to 6,000% over time, not in one trade. So I'm going to go over all the 4 rules today. You do not want to miss out on this. The last thing you want to do is miss out. It's going live at 1 p.m. Eastern Time. Tune in, even if you stop by earlier this week, as I'm going to be giving away 5 stocks to take action on right now. 5 stocks to take action on right now. You guys are going to love it. Value, 5 free stocks. You could take advantage of them right now. Follow the link below. Don't miss out. It's happening at 1 p.m. It's not a replay. It's a brand new event. I'm not just going to press the play button. I'm going live. It was fun when we did it on Tuesday, and we're going to do it again today. Follow the link below. Check it out. And don't forget, Monday, weekly threats, biggest opportunities, what stocks to focus on. Keep your eye right now on XLY, the discretionary sector, volatility, and put the call ratio. It'll tell you everything you need to know and those levels that I told you about on the SPY, S&P, and XLY. Hope it helps. Have a great weekend. Follow the link below. And if you're watching on YouTube, the video is in the Wealth Press YouTube channel. Follow the link below this video and have a great weekend. Send me some love letters. support@marketgeeks.com. I want to hear from you. I want to know how you're doing in this tough time and if I'm helping you at least a little bit. Bye, guys. Have a great weekend.